November has been one of the worst months of the year so far, and we're only halfway through it. Meta itself is down around 6% this month, and when we take a look at the last 3 months, well, it's not been performing great at all. It's down more than 20%, and we're noting a huge divergence from this company against the rest of the market. Having said that though, we are seeing a broader pullback in tech even after shutdown relief fades, and we're also seeing quite a significant thing in that rate cut expectations for December, something that investors believed was nailed on, is now slashed, looking like a 50-50, and valuations, as we've been saying for quite some time, do look very elevated. We're also seeing hedge funders now flipping from heavy buyers to heavy sellers. When we actually look for Meta in particular in the latest quarter, they bought around 11 billion worth of shares in Q3, but they actually dumped nearly 3 times that much, around $28 billion. And whilst we're also seeing insiders continue to sell their shares, that alone isn't necessarily a bearish signal, but it does in fact add to all of the pressure today. So we're going to break down 2 key questions. Number 1, what exactly caused Meta's drop, and is it ultimately justified? And 2, is this a dip we should be buying with both hands, or a setup we should avoid completely? And let's dive in. First thing we want to say, if we look at their 52-week and all-time high, around $800, they're around 25% lower, pushing them right towards the lower end of the 52-week range. They're up now only 6% in the last year, only 4% year to date, so they've massively underperformed the S&P under these 2 time periods. Over the last 10 years though, if we do zoom out, we can see outperformance up 468%. Interesting to see Wall Street see this as a strong buy, 4.58 out of 5, Seeking Alpha with a buy at 4 out of 5, and Quant do give this 1 a hold. Now we'll kick things off with valuation at a high level before we end up looking at our own discounted cash flow valuation. On a forward P, they sit at 20.6, that is below the 5-year average of 23.2, so it does tell you a few things about the company. Firstly, this isn't one that historically trades at very high valuations like we do see in other tech and Mag 7 companies. Also, in fact, this one did get as low in mid to end 2022, around 11 on a forward basis. And if you want to look at the highest valuation, well, 2021 around the 29 level, but we also saw that in 2025. So yes, a massive drop to where it does sit now. And in isolation, when we compare it to the average, we would call this a potential undervaluation signal, for which when we look at the blue tunnel, which as always for newer viewers highlights the intrinsic fair price, does give us confirmation again of undervaluation as it sits just below the bottom end. Noted that during Liberation Day, but actually for quite some significant periods in the last 12 months, Meta Platforms did trade at a premium overall, sitting above the upper end. Other thing to notice is that the intrinsic price, while slowly, has been increasing. That is something you always want to see. And if we zoom out to the last 5 years, well, there would have been ample opportunity to buy this one severely undervalued. You'd have to go back to around 2022, and if you did execute and buy, you would have got this around the $100 mark. Zooming out even further though to over the last 20 years, what you will notice with Meta Platforms, something we see with many companies, there are opportunities to buy this severely undervalued, but it does also go through periods where it trades in a reasonable signal, and likewise, as we've seen in the more recent time, at an overvalued level. So something to always keep in mind, and make sure you're subscribed, notification bell is on. When we see companies like we saw Meta trading severely undervalued, we will let you know. So maybe you're surprised to see this valuation grading at an F. Ultimately, one of the drivers is when we compare it to the sector median, it's trading at a 56% premium. As always, sector median has low quality companies, and we do believe the majority of companies we cover are at the upper end high quality spectrum. Other thing though is the price to earnings growth below 2 gets us excited. Below 1 could be considered an incredibly screaming opportunistic buy. 1.5 though, that is pretty much around the same level as the sector. also similar to their own 5-year average at a very small 4% discount. But this is what we touched upon earlier. The market is in fact in a little bit of a downward trend. Valuations are very, very high, and it is clear to see when we look at the S&P 500 heat map on a PEG basis that many companies are well above 2, so opportunities are running very, very thin. Meta Platforms, though, could be one to seriously consider today. And because we do incorporate this into our own valuation, we should let you know that many analysts, after their earnings, have started to lower their price target, although these levels, given where the company sits at today, still does offer some strong upside if you do consider it in your overall investment thesis. We have one lowering it to $800. Clearly, the higher AI spending, something we'll discuss today, is on most analysts' mind. We have Bank of America dropping it quite significantly from $900 down to $810, as well as RBC Capital to $810. Again, many analysts have in fact followed the same pattern. And look, one of the biggest issues that they are facing when considering Meta overall is that they're spending a lot of money on their capex. In fact, what we've noticed from the lows of 2024, at least in the last few years, at 18% of capex spending as a percentage of revenue, it's now sitting sky high at 37%. That is even higher than the peak that we noted in 2022 at 34%. So to put it into context, for every $100 of revenue, this isn't profit, this is top line revenue that the company generates, $37 of that goes straight to their spending on capex, and you could argue that that's very good. They're putting that money so that they can at a later date see an increase to their top line. The question is, do you trust the company enough to really put that money to use, or in fact are they just burning this through? That is something that clearly, given the share price drop, investors are starting to grapple with. And as we said, this is giving them a bit of PTSD from the 2022 metaverse route. But what's interesting, from that point, they're actually spending a little bit more, as we just pointed out, 37% versus the 34% from 2022. And in fact, the spending doesn't stop. They're saying they're going to spend $1 billion to build AI data centers in Wisconsin. Now, you can again look at this at two different ways. It's very important when you are looking to buy this company that you do believe Zuckerberg can in fact put this money to use and will at a later date see all of this and a significant amount more in terms of a return. And it doesn't look like it is going to be stopping anytime soon. We'll cover how much they're spending in the last few quarters and over the last few years, but in 2026, next year, they're expecting to spend even more, and all of this is putting a lot of downward pressure on the share price today. And in the latest call, they mentioned that the very worst case would be that they've effectively had to pre-bill for a couple of years, in which case, of course, there would be some loss and depreciation, but that they grow into that and use it over time. So they don't really see any downside to all of this spending. They believe they may in fact be early, but that is just one small negative in which they see a ton of upside. Again, you really have to trust management that they know what they're doing, and that could be a benefit if you do, because Wall Street are in fact selling a lot of shares, and those who took advantage of that 2022 drop, well, maybe we are seeing a little bit of a similar reflection. But then we also have to consider it wasn't that long ago where all we heard about was Mark Zuckerberg poaching many new recruits from different companies, OpenAI, Google, just some of the names, and we're talking significant amount of just signing on bonuses. We'll look at this article from the 1st of July this year, and now we see here that Meta are to axe hundreds of AI jobs after offering $100 million signing on bonuses. So look, that is a little bit negative. If they're just throwing money about and they're not really putting it to good use, then ultimately as a shareholder, this isn't really where you want to see the money going. Something again just to take note of. And as we said, in terms of the capex, something that continues to increase, they're expecting even larger in 2026. And when we take a look, they've now spent around $63 billion over the last 12 months. That has been increasing 39% every single year. So we're not talking about small amounts, as we've highlighted. Just against a percentage of their revenue, it's sitting at 37%. And quite importantly, we need to be looking at a very profitable company in order to be able to do a lot of what they're doing. And we do notice in A+, their gross margin is 82%. That is significantly above the sector at 54%. Also, improvements to their 5-year average of 81%. As always, we like to see this. Efficiencies noted. Bottom line margin at 31%, well above the sector as well at 4%. And we also notice not too dissimilar from their 5-year average. In terms of the cash flow they're generating from operations, we're talking 108 billion over the last year. Massive improvement to their own 5-year average at 64 billion, allowing them to do a lot of this capex spending. Now, one thing that's very worth noting, and we did touch upon this not that long ago, is that Michael Burry did come out with something that you could argue had some effect to the drop we saw last week. Now, he's saying here, and it does in fact relate to Meta, where he points that out alongside Oracle, that understating depreciation by extending useful life of assets artificially boosts earnings, one of the more common frauds of the modern era, and that is something he has in fact said that Meta are doing. And ultimately by 2028, so just in a few years time, Meta will be overstating their earnings by 20.8%. That is something to consider, although again, this is just one super investor. It doesn't mean what they say is in fact correct, and we can see he points to them massively ramping up capex through the purchase of Nvidia chips and servers on a 2 to 3 year product cycle should not result in the extension of useful lives of compute equipment, and he's basically saying the likes of Oracle and Meta are extending it much longer than what should actually be the case. But if we're going to talk about Michael Burry, we also need to point out that he did not that long ago mention that he will be closing down his fund. We can see here, with a heavy heart, I will liquidate the funds and return capital, but not for a small audit tax holdback by year's end. And he says, my estimation of value in securities is not now and has not been for some time in sync with the market. So just something we have to point out if we are going to discuss his point that we just touched upon. But ultimately the big thing for Meta, as we just go back to highlight, is accelerating AI spending regardless of how strong the numbers they are producing. Now we do have to give them credit. Over the last 4 quarters they have outperformed analyst targets, 100% track record, sometimes by some very large numbers, but over the next 4, nothing too glamorous. We're talking around the low to mid single digit, but you could argue based on their EPS for next year, the forward valuation dropping to around 20 could make this solely on a valuation perspective incredibly attractive, especially when you look at others in the Mag 7. This one is in fact now trading at the lowest, and it wasn't that long ago we were talking about Google in a very similar position, and look how that one did in fact turn out. Now their latest earnings we can see, and as we highlighted, always seems to be very strong, up 26% year on year. Advertising is the real driver at 25% year on year, although that is basically their business model. We're talking the likes of Facebook, Instagram, WhatsApp, Messenger, and a few others. And their operating profit, whilst it has been a little bit inconsistent, the general trend over the longer term has been an increase, but Realty Labs continues to see a large loss, something that they haven't for the time being stepped away from. And if we look at their growth, where they get a C+, they grew last year, full year, 21%, projecting around 20 this year, not too dissimilar, well above the low single digit of the sector, and they're actually growing slightly faster than they have done over the last 5 years. They're also projecting 16% growth to the EPS over the next 3 to 5, well above the sector at 10, but a little bit below their 17% historical. And it's quite interesting to see, given Meta's whole business model is in fact around advertising revenue, Google, large portion, also very similar. But whilst we notice Meta is in fact smaller than Google search, the advertising element over the last 5 years has been growing slightly faster, 19% versus 17. It may not be that long before we actually see the Meta advertising segment grow faster than Google search. That is what, as an investor, you will be hoping for, given how high this capex spending is. You want to ultimately see a very large return. But there are also other positives to come out of their latest quarter. We note for the first time in a while double-digit growth to both the average price paid per ad as well as their ad impressions, looking very good. Their operating income as well over the last 10 years, if we do zoom out, has been growing at a CAGR of 30%, but maybe you want to see the opposite. You want to see it decrease if you want this company in the longer term to take advantage of maybe a much larger drop. And we also notice their revenues continue to increase over the longer term, whilst they're becoming a lot more efficient with less and less employees. But again, we just touched upon they were doing large sign-on bonuses, and now they're cutting a lot of those AI jobs. You just want to see management be a little bit more clever with all of the cash that they're holding on to. And the other point here is they sold not too long ago $30 billion of bonds, all of this to really help with the acceleration of their AI spending. And they also had a financing deal with Blue Owl Capital, again for data centers, something that seems to be the case for many of the Mag 7 companies. But really something worth pointing out that all of this financing that they are doing is essentially helping keeping off the debt of Meta's books and freeing up the balance sheet. Now, some investors will look at that and believe that the debt does belong to Meta, but they're just putting it off the books, and something to consider when we do talk about this company, because ultimately that affects the valuation as well as the overall health check of the company. But as ultimately where some analysts are starting to get very, very nervous that Meta is taking on a lot of debt, and that for investors it doesn't look as transparent as maybe it should. And something that I personally found very, very interesting is that Meta is earning a large amount of money on fraudulent adverts. We can see here that 2024 they projected around 10% of their revenue came from scams. I'm sure you've seen a lot of these on their platforms, and it says that they run around 15 billion scam ads every single day, and it's saying amongst that they're charging them at a bit of a premium. Does sound a little bit weird, something to factor in, because when we do hear a lot of bearish reports, as you normally do when Mag 7 as well as the large companies start to fall, this could come at the forefront with potentially 10% being knocked off their top line moving forwards. And ultimately the question is, as we've highlighted and want to reinforce, whether or not they will be very successful in this AI race, and that is why investors are seeing this valuation looking very, very attractive. Now, we'll also flag when we look at their top line revenue, growth does look very strong. 10 years ago, in fact, they reported 18 billion. They've now reported in their most recent annual accounts 165 billion, with on a trailing 12-month looking like that top line is only going to increase higher and higher. But as we always say when looking at companies, also and more importantly, look at their bottom line net income. Does it follow suit? Is bottom line net income growing consistently as top line? For most part, the answer is yes for Meta, where they reported 4 billion 10 years ago, now sitting at 62. But interesting to point out that whilst for the revenue we did in fact see trailing 12 month looking like it's going to increase, bottom line does look like it will be taking a dip. Again, these are things you should really consider when looking at a company. It isn't just a simple yes buy or no sell. And the other thing is a quick health check, total cash versus total debt. 18 billion 10 years ago, now sitting at 45 billion. And one number here, pure isolation, isn't going to give anything away. So we compare it to their total debt numerically and directionally, where it was 300 million 10 years ago, now sitting at 51 billion, and actually their cash is a little bit less than their total debt. Not a red flag, but as always, something worth keeping up to date on every single quarter. And when picking individual stocks, ultimately you want them to outperform the likes of the S&P, otherwise you would just in fact look at investing something like VO. Meta over the last year is in fact up 6%, S&P up 13, QQ up 20, so they have in fact underperformed. They've actually outperformed when we zoom out to the last 5 years, the S&P, which was up 86%, but only slightly outperformed the QQQ. Meta up 120, QQ up 114. Over the last 10 years, now this is very interesting given the drop, Meta with 471% gain has outperformed significantly the S&P, which is up 221, but now we're seeing it pretty much in line with the QQ, a little bit below where that sits at 474. Remember though, as always, past performance is not an indicator of the future. And then we can highlight some of their underlying metrics. The first one is the free cash flow per share. You want consistent growth over the long term. That is what we get very strongly for Meta, although just a little bit inconsistent. That drop in 2022, very notable. And you'll also see that over the next 1 month, it is anticipated to drop very significantly. And one of the main reasons is that very, very large acceleration in CapEx spending. Sales growth looks very strong, double-digit growth nearly every single year, 22% in 2024, expected there or thereabouts for 2025. And something maybe that goes under the radar is that they have started to do some share buybacks. Not a lot, very small in fact. It was around 2.86 billion a few years ago. now at 2.59. It will be a strong sign to investors if we suddenly see them announce a very large share buyback program. As always, when shares are bought, it does ultimately return excess cash to investor pockets. ROIC, very strong, minimum 10% is what we want to note to give us faith management are able to effectively allocate their capital. 11%, now sitting at 26%. Very, very important for this company given how much they're spending on AI. And in terms of the margin, whilst it is inconsistent in terms of the growth, still very strong at 43% on a trailing 12 month, and similar on the free cash flow, whilst it has decreased, still healthy at 24%. Just hopefully we don't see the continuation of that downward trend. Now, net debt to EBITDA, this is one of our favorite ones alongside the ROIC, highlights the number of years it would take Meta to pay off all of their debt net of cash on hand. Below 3 is what we want, correlates to balance sheet strength as well. 0 over the last 10 years. We do see it now at 0.05, as we just pointed out that their cash balance is slightly below their total debt, but does still look incredibly strong. Just before we jump into our DCF model, we want to let you know we have released our latest free weekly article. We draw on every single Sunday morning to your inbox, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to grab a spreadsheet of November stocks that look severely undervalued. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet released just yesterday of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now, our intrinsic price gets to $798 solely from the DCF, where we've used a growth rate of 12%, below the 10-year average of 34%, below the last year at 23%, so you could already say very conservative, and in fact we have used the lower end of our low, medium, high, 12, 14, 16 respectively. As always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Meta or any others, but we do have to kick off with maybe the most useful piece of information. If you're buying around $609, you will note on a reverse DCF, 8.2% growth is baked in. So if you believe Meta can grow much faster or even slightly faster, then you're looking at an undervalued level. If you believe no, they will grow slower, then this could look potentially overvalued. Regardless, whether you use 12, 14, 16, double-digit upside right across the board, and using the 12% growth rate with a discount rate does give us the present value of these future free cash flows, where we add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 798, indicating 31% upside. If you want to use 14, well, 919, 51% upside, and if you want to use the higher end of 16, over $1,000, 74%, but we will be very conservative today, use the low rate of 12%, because we want to know what is the margin of safety on offer. Typically, we kick off with 10%. We buy if it meets the 3 criteria of a wide moat, strong financial metrics, good forward-looking data, but we don't even need to start off there, because today we're getting a 23.7% margin of safety. If you wanted more at 30, well, it would be a buy at 559, but Wall Street, as we highlighted at the beginning, with their strong buy rating, overall on average have an $845 price target, indicating 39% upside. If you want to use the middle rate, which is what we typically do use for companies, you are getting a 34% MOS for Meta today. And if you want to go one step further in terms of being conservative, at 10%, we're talking $693. That is a 12% MOS. And if you believe, you know what, 10% is the most reasonable, well, at 20%, a buy at 554 and 25, 519. So give us your overall opinion of Meta Platforms, but we believe using the more conservative rate of 12% from the low, medium, and high, that ultimately, as an investor, we're looking at a 24% margin of safety with projected Wall Street upside of 39%. Let us know your views though, whether you believe Meta is now a buy, hold, or complete avoid. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.